Here's a scenario I want you to imagine. You've been searching for a home for months. You've toured more houses than you can count. You've gotten your hopes up and talked yourself back down again more times than you like to admit. And then this happens. You walk into a home and you just know it. Great school district, bigger yard, updated kitchen, home office, the whole thing. It checks every single box. You put in a strong offer and you feel good about it. And then your agent calls you with the news. You lost it. Not because your price was too low, not because you asked for too many repairs. You lost it because the sellers took a clean offer over yours. And your offer was contingent on selling your current home first. If that's happened to you, you know exactly how it feels. And if it hasn't happened yet, but you're heading into the Northern Virginia and Southern Maryland market as a move-up buyer, I'm going to help you make sure it never does. Today, I'm breaking down the full playbook, how buyers in this market are purchasing their next home before selling their current one, without moving twice, without draining their savings, and without playing a dangerous game of timing that keeps most people stuck. Let's go. Let's start with the reality of what's going on in Northern Virginia right now in mid-2026, because context matters here. Inventory is genuinely tight, particularly in most desired pockets. We're talking Arlington, Reston, McLean, Ashburn, Prince William County, Fairfax County, and parts of Charles County, where demand for federal workers, contractors, and tech sector employees keeps prices elevated and competition consistent. When a well-priced home hits the market in one of these areas, it's not just sitting around waiting for you to get your ducks in a row. In that kind of environment, sellers have real leverage, and the savvy sellers, they really know it. When a seller reviews two offers, one's clean, and the other is contingent on the buyer selling their current home, the math is simple for them. The contingent offer isn't just an inconvenience, it's a risk they're being asked to absorb. They're betting that your home sells, that your buyer's financing holds, that your timeline lines up with theirs, and that nothing falls apart at any point along the chain. That's a lot of what ifs that all have to go right for them. Here's something a lot of buyers don't fully appreciate. In the past, a home sale contingency was fairly standard, and sellers were somewhat used to navigating them. But the competitive market conditions of the last few years have conditioned sellers in the Northern Virginia and Southern Maryland area to expect better. They've seen clean offers win. Their neighbors got a clean offer. The listing agent isn't even telling them to hold out for one. So even if your offer is $10,000 or $20,000 higher, you can still lose to a cleaner offer at a lower price. The bottom line is, if you want to compete in the Northern Virginia and Southern Maryland market as a move-up buyer, you need to be able to shop without a home sale contingency attached to your offer. You need to present yourself as serious, capable buyer who isn't asking the seller to take on risk. And the good news, and this is the whole point of this video, is that there are now multiple real, well-structured financial tools that help make this possible. So let's walk through each one of them. Option 1. Bridge financing and buy before you sell programs. This first major tool is a bridge loan. And while bridge loans have existed for decades, they've had a real resurgence in 2026 as more move-up buyers realize they need an alternative to the home sale contingency. So here's how a bridge loan works at its core. It's a short-term loan, typically 6 to 12 months, that lets you borrow against the equity you've built in your current home. You use these funds as a down payment on your next home, make the purchase, and then pay off the bridge loan when your first home sells. Now let's talk about what it costs, because you should go into this with your eyes open. Bridge loans carry a higher interest rate than a standard mortgage, often 1 to 2 percentage points above current conventional rates. But here's the key. You're only holding the loan for 60 to 90 days in most cases. If your bridge loan carries an extra 1.5% in interest for 75 days on, let's say, a $200,000 draw of equity, that additional cost is somewhere in the neighborhood of $600 to $800. In the context of securing the right home at the right price, in the right neighborhood for your family, that math often works very comfortably in your favor. Now, some of you are thinking, what about a HELOC? I already have equity. Can't I just use that line of credit? And this is a legitimate question because HELOCs do offer a lower interest rate and are more flexible in theory. Here's the complication though. The moment your current home goes on the market, most lenders will freeze or close your HELOC. It's a standard policy because a home being listed signals a potential sale. and lenders don't want to extend credit on an asset that might disappear. So unless you secure the HELOC well before listing and time it carefully, you may find that door closes faster than you expected. Beyond bridge loans, there's a newer category of products you should know about, often marketed as buy before you sell programs. These are offered by a growing number of specialized lenders and real estate companies operating here in the DMV. The way they typically work, the company assesses your current home's value, provides a guaranteed offer or a cash advance, and then lets you use those funds to purchase your next home. Once you've settled, they help you sell the original home through an agent. Some of these programs charge a convenience fee and are slightly below market guaranteed price, but for buyers who want to know exactly what they'll net on the current home before they commit to buying the next one, this kind of program can be a genuinely powerful option. If you want recommendations on which programs are worth a serious look in the DMV, drop a comment and I'll follow up. Qualifying for 2 mortgages. Let's tackle the question I get most often when I talk about this strategy. Can I even qualify to carry 2 mortgages at the same time? The answer is yes for a lot of buyers. But the details matter, and you need to know what the lenders are looking at before you assume you're in the clear. The primary number here is your debt to income ratio, or DTI. This is the percentage of your gross monthly income that goes towards monthly debt obligations. On a conventional loan, most programs want your total DTI, meaning everything including both mortgage payments, any car loans, student loans, minimum credit card payments, to land at or below 45%. Some programs, particularly those backed by Fannie Mae and Freddie Mac, have some flexibility beyond that threshold depending on your overall loan program. But 45% is the practical benchmark to work from. In Northern Virginia and Southern Maryland, we're frequently working with high balance conforming loan amounts, meaning loan amounts above the standard limit that still fall under the elevated limit for high cost areas. In these scenarios, underwriters apply additional scrutiny, particularly around your reserves, which we'll cover in a moment. Here's a strategy that's often overlooked and can dramatically improve your DTI picture. If you plan to convert your current home into a rental rather than sell it immediately, you may be able to use a projected lease agreement to offset the departing mortgage payment. Here's what that means practically. Let's say your current mortgage payment is around $2,800 per month. If a lease agreement signed by a real tenant or a qualified prospective tenant shows rental income of $3,200 a month, many lenders will allow you to exclude or significantly reduce the $2,800 from your DTI calculation. That one move can be the difference between qualifying and not qualifying. Now, reserves. This is where I see buyers get surprised. In high balance loan scenarios, local underwriters are typically looking for 6 to 12 months of mortgage payments for both properties sitting in a liquid or semi-liquid accounts. That means savings, checking, brokerage accounts, and in some cases, retirement accounts at a discounted value. What it does not mean is the equity in your home. Equity does not count as reserves. So before you go deep into the process, sit down and add up your actual accessible cash and investable assets. If you're short on reserves, there are strategies to address that too, but you need to know where you stand. The rent back strategy. All right, we're now going to talk about one of the most powerful and underused tools in a move-up buyer's toolkit, the post-settlement occupancy agreement, more commonly known as the rent back. This is actually my favorite approach. Here's the concept. You purchase your new home, you close, you take title, and the home is legally yours. But instead of immediately moving in, you negotiate an agreement to remain in your current home for up to 60 days after your new purchase closes. You pay a daily occupancy fee to the buyer of your current home, essentially a per diem rent. In exchange, you get the time you need to prepare your home for sale, stage it properly, and coordinate the logistics of moving without feeling like you're in a race against the clock. Now, you might be thinking, why would the buyer of my home agree to wait 60 days? Here's the thing. In a competitive market, buyers who want a particular home are often willing to offer flexibility to win, and a well-structured rent back is a legitimate, commonly used tool in the real estate transaction. It's not a strange ask, it's negotiated all the time. But here's where the rent back gets really interesting on a buyer side. When you're making an offer on your new home and you ask for a rent back from those sellers, you're actually offering them something valuable. The seller of the home you're buying might need time to find their next home. They might need 30, 45 to 60 extra days. A buyer who comes in and says, "We'll close on your timeline and give you up to 60 days of occupancy after closing," that is a genuinely compelling offer in a low inventory market. It can be more attractive to a seller than a slightly higher price from a buyer who has a rigid 30-day move-in demand. From a carrying cost standpoint, the math also works in your favor. Let's say you close on your new home in August. You stay in your current home through September under a rent-back agreement. During September, you're paying the occupancy fee on your current home and your new mortgage simultaneously. But you're also staging and listing the old home, and you're not paying for any short-term rental or storage unit in between. For most buyers, this approach results in a lower total out-of-pocket cost than a traditional sequential move would. One important note, most lenders require a rent back to be 60 days or less. If you need more time than that, there are creative ways to structure the transaction, but 60 days covers the vast majority of scenarios and is the standard you should plan around. Executing the post-purchase exit strategy. You bought the new home, you used the rent back to stay put while you get organized. Now it's time to execute on the sale of home number one. And this is where the whole strategy pays dividends. Let's start with timing your listing. The ideal scenario is that you've used your rent back period to declutter and make any targeted improvements, all while you're still living there and have just vacated. You don't want to wait too long after the rent back ends to list, because every month you're carrying two mortgages costs real money. But you also don't want to rush onto the market with a home that looks lived in and chaotic. 2 to 3 weeks of focused preparation after your rent back ends is usually the sweet spot. This is where selling vacant or lightly staged genuinely outperforms selling occupied in most every scenario. Buyers walking through a vacant home are doing something very different mentally than buyers walking through someone else's furnished space. They're projecting their life onto it. They're picturing their couch there, their dining table, their kids running down the hallway. When a home is full of your stuff, especially if it's packed or cluttered from a partial move, that mental projection gets blocked. Staged or vacant homes photograph better, showing better, consistently receive stronger offers. I'd also encourage you to think about targeted pre-marketing improvements. That doesn't mean a full renovation. It means fresh paint in neutral tones, professionally clean carpets, or refreshed hardwoods, updated light fixtures, if they're dated, and give your home some curb appeal attention. In Northern Virginia and Southern Maryland, where buyers are sophisticated and have seen a lot of homes, first impressions carry enormous weight. A $5,000 to $8,000 pre-list investment can return $15,000 to $30,000 at closing, and it compounds with staging to create a home that feels move-in ready at a premium price point. Once your first home sells, here's the final and often overlooked piece of this strategy: the mortgage recast. A recast is not a refinance, and that distinction matters. A refinance involves closing costs, new application, new interest rates, and a whole process. A recast is simply this: you take the net proceeds from your first home sale, make a large sum payment toward the principal of your new mortgage, and ask the lender to re-amortize the loan at the same interest rate. Your payment drops, no closing costs, no rate risk, no new application. It's one of the cleanest moves in personal finance. Most homeowners have never even heard of it. Let's say your new mortgage is $750,000 and you apply $200,000 to your first home's proceeds. Your lender recasts the loan on that remaining $550,000 balance, and your monthly payment could drop by several $100s per month permanently without touching your rate. That's money back in your pocket every single month going forward. Okay, let's bring it all together. The Northern Virginia and Southern Maryland move-up market does not have to be complicated or stressful. You don't have to choose between making a contingent offer that gets ignored or selling first and living in limbo, waiting to find your next home. There is a third path, and it involves bridge financing or buy before you sell programs to access your equity, careful DTI and reserve planning to qualify for both properties, a strategic rent back to control your timeline, a smart listing of your first home to maximize your net proceeds, and a mortgage recast to lock in lower payments for the long haul. If you're thinking about a move in Northern Virginia or Southern Maryland in the next 6 to 12 months, the most single valuable thing you can do right now is get a clear picture of your equity position and your DTI before you start shopping. That way, when the right home hits the market, you're ready to move fast and clean. I'd love to hear where you are in the process. Drop your situation in the comments. What's your biggest concern about buying before you sell? I read every comment and I do my best to answer. If this video was helpful, please subscribe and hit the notification bell. I post Northern Virginia and Southern Maryland real estate strategies every week. Okay, bye for now.